All right, so now we're going to go back and pick up where we left off, talking about bonds and bond pricing. So just a quick overview. Bonds are securities that are sold in the marketplace by borrowers, and a bond enables a corporation or a government to raise funds in exchange for paying interest to the investor, and then eventually in the future, there will be a repayment of the original invested principal. Okay, so this is a very common way for corporations to raise funds. In fact, most corporations issue some combination of stocks and bonds, but some will issue a very large percentage of bonds compared to the stocks that they've issued. Some corporations mainly issue stocks. Every situation is a little bit different. For example, Microsoft and Apple do not issue a large amount of bonds. Most of their capital comes from stocks. At the other extreme, we have, manufacturing companies that tend to have higher amounts of debt, and so they will typically finance that debt with bonds. There's advantages and disadvantages to both financing with equities or stocks and bonds. In fact, while we're discussing this, maybe we can quickly run through this. Hold on one second. How about we'll call this the pros and cons of debt financing. Okay, so just a quick overview here. Okay, so corporations can raise funds, capital, in many different ways, but the two most important ones are by issuing equity, which means stocks, or debt, which is bonds. Equity has the advantage that no payments are required to be made to the shareholders. Their profits come from capital gains or increases in share price. So in other words, if you buy a share of stock, what you're really hoping for is that the price goes up. I mean, that's really what this is all about. The issuing corporation is not obligated to send you any payments, although many corporations do provide what are called dividends. Let's say they make cash payments to the shareholders known as dividends. Now, these dividends are completely optional, and they're really not a very large amount of money. In fact, in a lot of cases, you have to kind of wonder why they even bother. Apple, for example, their stock price is almost $200 a share, and their dividend payment is something like 77 cents. We can actually look it up really quickly. Let's see. So if you go to finance.yahoo.com and you look at their recent history of stock prices, yeah, here it is right there. Oh, it's even lower than I thought. So this stock is selling for $189.54, and every quarter they provide a dividend to the shareholders. The last one was 25 cents. So that means at the end of the year, you're looking at $1 based on a stock that's worth almost $200. So it's a very trivial amount of money. Like I said, a lot of corporations in this day and age don't bother with dividends anymore. It used to be a much more important source of income for stockholders. Now, by the way, having said that, there are some corporations at the other extreme that pay fairly significant dividends. For example, the Coca-Cola Company has always made a significant dividend payment throughout their entire history, which goes back to the 19th century. And if you look at their price is only $62.58, and their dividends, the last time they paid a dividend, it was 50 cents. Now, again, it's only 50 cents, but still, we're looking at 4 times a year, $2 out of $62. What percentage does that represent? That's about 3.2%. Now, that doesn't sound like a lot, but you know what? That's a lot more than you're going to get in a typical savings account or checking account. And that's on top of any capital gains you may earn when the price of the stock goes up. So Coca-Cola has a good year. You're getting both dividends and possibly capital gains. Okay. So with Apple, on the other hand, because it is a high-tech company, if you look at the recent history of Coke stock, it took in the last 5 years, it's gone from about $50 to 62. So in other words, the growth rate for Coca-Cola stock is not that high. So that's why it's important to get these dividends. Whereas with Apple, most of the gains to the shareholders will, of course, come from capital gains. If you look at their 5-year history, for example, the stock price has gone from about 44 to almost 200. It's gone up by roughly more than 4 times in just 5 years. So in other words, when you buy Apple stock, you couldn't almost care less about the dividends. What you're really looking for is these capital gains. So Apple finances its operations by issuing some combination of stocks, as you see here, but also bonds. Okay, now, if you're interested, you can look up somewhere in all of this information, you'll find how much debt they actually have. And again, you'll see that the proportion of equity versus debt depends typically on the industry in which the company is based. Typically, high tech companies have low amounts of debt. Heavy manufacturing companies that produce, let's say, steel, tend to have high debt levels. But most corporations do have some of both. Okay, there are some that only have equity, but there are none that only have debt. That would be terribly, terribly risky because now, by the way, we forgot to mention the one drawback to equity financing. The good thing is that we're never required to make any payments to the shareholders. They buy the stock, they take their chances. But the only drawback here is that, at least from the perspective of the corporation, is that the owners of the corporation, which means the shareholders, must share their profits with new shareholders. In other words, if somebody buys stock, there's more people to share your profits with. So that would be the only drawback. In other words, the amount of profit that's available at the end of the year is being split up among a larger number of investors if they sell more stocks. So in other words, you as the shareholder are finding that your ownership percentage is smaller than it was when those shares were sold. So you're basically finding yourself with a somewhat diluted share of the company. Now, on the other hand, what's so great about bond financing or debt financing? Okay, with debt financing, the bondholders do not share the profits of the corporation. Instead, they are paid, they're compensated, let's say, with interest payments. And when their bonds mature, they are repaid the face value of the bond. It's exactly like a loan. Let's say $1,000 bond basically means you're lending $1,000 to Apple. You're getting interest payments for a fixed number of years, and at the end, you get your $1,000 back. So you're not getting any profits. You just get your interest payments. So you're lending money to the company in exchange for whatever rate of interest they happen to be paying. So from the corporation's perspective, means we're not sharing our profits with anyone, but we better make these payments on time. Interest payments and the repayments of principal must be paid on time. Otherwise, bankruptcy can result. And in fact, many corporations have gone under because they couldn't pay their debts. That's usually when bankruptcy is declared, that's the reason, because they have too much debt. Now, sometimes with the Chapter 11 filing, the company may be able to restructure their debt. In other words, offer the bondholders better terms. They may, for example, offer a lower rate of interest. They may offer them a longer time frame over which to repay the debts. And then that way, hopefully they can stay in business. But if not, the bondholders are left holding the bag because the money they were promised is probably never going to be received, or at least not very much of it. So with debts like this, there's risk to the corporation and there's risk to the investors. The investors are worried that the money won't ever materialize. The corporation is worried that they'll run out of money to pay the interest and principal on these bonds that they've issued. So why do they do it? I mean, really, what's the point? Why don't they just go ahead and finance their entire operation with equity? Well, the big advantage here, there's really two advantages. The most important benefit to the corporation is that the interest payments to bonds tend to be relatively low compared with the rate of return or the capital gains that stockholders earn. In other words, it's typically cheaper to issue bonds than stocks. And here's really the big plus from the corporation's perspective. Most importantly, the interest payments on bonds are tax deductible to the corporation. Not dividends, not capital gains, but these are. In other words, the interest that we're paying is reduced by whatever the tax bracket is that we're in. So a lot of corporate planning, a very large percentage of it comes down to the minimization of taxes. And so when the company is faced with a choice between diluting the ownership of the company with stocks and paying or issuing bonds with a relatively low coupon rate and tax breaks on top of that, often the choice is pretty simple. Many corporations would rather just issue more bonds than start issuing more stocks. In fact, many corporations, after they've issued stock for the first time through an IPO or initial public offering, they never issue any new shares ever again. That's it. They're done. One time only. From then on, it's all debt. Okay, it does happen. Now, from the perspective of a government that's borrowing, that's a little different because that's not a profit-making organization. Governments borrow because they have to. It's very unusual to find a government in this day and age that doesn't have deficits every year. It just doesn't happen. The government, the federal government, typically in a normal year will spend, let's say, $4 trillion, and then tax revenues will be, let's say, $3.2 trillion. Where does the rest come from? They issue treasury securities. They borrow. Now, this is a little bit different because the interest payments on these are quite low. Government can issue bonds with low coupon rates due to their unique credit situation. In other words, it's a government. It's a corporation can go out of business. A government can't go out of business. If they don't have the money, they can raise taxes. If they don't have the money, they have a lot of assets that they can sell. There's things they can do to raise the money, and they will because they know that their credit rating depends on this. And it's their very good credit rating that makes it possible to issue treasury securities with fairly low rates of interest. Okay. So, and also there are potentially tax breaks. I don't know enough of the details, but I'm pretty sure that federally issued debts are not taxable by the states, if I'm remembering this correctly, but there's definitely some tax benefits to the investors. And so this is a little bit different than corporations. They are trying to increase their profits, whereas governments are trying to cover their deficits. Okay. And by the way, I just want to quickly mention here, there are different kinds of treasury securities that you can buy. We looked at a list the other day, but I just want to mention that as far as the terminology goes, they're all classified by their maturity. In other words, how long until you get your money back. Treasury bills have maturity from 1 month to 1 year. Treasury notes, maturity from 2 years to 10 years. And then finally, treasury bonds, maturity from 20 to 30 years. So when you hear those terms tossed around in the Wall Street Journal, let's say, that's what they're talking about. Sometimes in the press, they don't get it right. You hear things said that are not strictly correct, but a treasury bond typically actually technically means 20 to 30 years, a note 2 to 10, and 1 month to 1 year means a treasury bill. They're all technically bonds, so it can be confusing, but this is the notation that we use in the treasury market. And the reason now, and by the way, I think I mentioned this too, most corporations, when they issue new bonds, typically the maturities are quite long, 10, 20, 30 years even. Very occasionally they go past that. In fact, many years ago, you can look this up on Google if you want. I think it was in the 90s. For some reason, and I don't know exactly why, the Walt Disney Company issued bonds that had a maturity of 100 years, and they were called Cinderella bonds. Now, you really have to be an optimist to buy a 100-year bond. But of course, the cash flows will go to your heirs if you die. But it was something that, let's say, made a lot of news. And at one point in history, there did exist bonds with a very interesting feature. Let me just mention this here, and I think we'll see this later on. So most bonds have a maturity of no more than 30 years. Partially because people, it's hard to, who's going to want to plan that far into the future, more than 30 years. You don't know what's going to happen in 30 years. It's very difficult to plan that far ahead. So bonds with maturities more than that are just not very popular with investors. So that's why they're not really typically issued, because there just isn't really a demand for them. But occasionally there are government agencies may offer 40-year bonds. They do exist, but it's kind of unusual. Now, I mentioned the Walt Disney 100-year bond. At one point in time, there have been a few cases where a government issued a perpetuity or a consul, which paid, which had no maturity date. In other words, what is that all about? In other words, the investor would collect interest forever, but would never receive the original principal face value. In other words, it's a loan where it's never going to be repaid. The interest will continue to be paid literally forever. So that's happened during the Napoleonic Wars. The British government issued these consuls. The idea was they didn't know if they were going to win, so they needed to borrow money. It seemed like a great idea at the time. So what happened with those consuls, by the way, is eventually the British government bought them back from the investors. So there are no more outstanding consuls, but they have been issued throughout history. Sometimes, interestingly enough, in addition to corporations and the US government, state and local governments can issue their own bonds. And when they do, they're called municipal bonds. So notice the state of New York has its own bonds. The city of New York has its own bonds. And the good thing about municipal bonds, from the perspective of the investors, is they typically provide very favorable tax breaks. They typically pay a fairly low rate of interest, but they also provide very good tax benefits. So they typically are bought by high net worth individuals. A classic example of this would be when it was decided that the Tappan Zee Bridge had to be replaced. The cost of that project must have been quite a large, obviously in the billions of dollars, which the state of New York doesn't have that kind of money laying around. So they would have issued bonds for the sole purpose of financing the new bridge. So that's what that's all about. And sometimes foreign governments issue bonds in the United States. Yeah, they do. Why not? Because this is where the capital markets are so large. I mean, if you're a fairly small country, there may not be enough available in your own markets, so you can issue bonds in the United States. These are called sovereign bonds. Now, it's very rare. It does occasionally happen. Sometimes the national government can actually run out of money. Argentina went through that in 2001. And so what happens then is that the government of Argentina can't be declared bankrupt and dissolved like a corporation. But what does happen is they get together with the IMF and they renegotiate the debt with the investors and they work out a plan where they can pay it off over a longer period of time. Maybe they are given a lower rate of interest. So the investors will end up losing some money, but it's not maybe as bad as a bankruptcy. So that has to be taken into account when people buy foreign bonds. So anyway, with all that being said, now that we have a little bit more understanding of bond markets and why they're issued, why don't we go ahead and start focusing our attention on how they're priced? Okay, so we started to address this the last time we met. We know that the bond has a fixed maturity date, which in this equation is n years in the future. The face value will be repaid to the investor. The C is the coupon rate, the coupon payment rather, and R is this special rate of interest known as the bond's yield to maturity. Which in effect, you could think of it as approximately the rate of return to the bond when you take into account the coupon payments plus any capital gains or losses that may take place. It's a little bit more involved than that, and we'll get to that in a bit, but it's enough for now to think about it as roughly the rate of return that you'll earn, assuming that nothing goes wrong. In other words, no bankruptcy or anything like that. And now the reason why, and by the way, let me just mention this as well while we're discussing the bond's price. When a bond is first issued, the price equals face value, which is often $1,000 in the United States. It doesn't have to be. It could be 10,000, let's say, or 100,000, but 1,000 is a common choice. And then the bond is redeemed at the face value at the maturity date. In other words, if you buy this bond, you'll get your $1,000 back at the end. In between, though, the market price of the bond can be different from the face value. Okay, so once it's been issued, there's no guarantee the price will stay at $1,000. In fact, it probably won't. The price will fluctuate in the marketplace. And so, how does that work? If interest rates in the market fluctuate, bonds price will fluctuate. Rates rise, the bond's price will fall. If rates fall, the bond's price will rise. So therefore, it is possible to earn a capital gain or suffer a capital loss if the bond is sold prior to the maturity date. Okay, so if you buy a 30-year bond from Apple and in 10 years you sell it, you might have a profit from that if the price has gone up, or you could have a loss if the price has gone down. So that will depend on what happens to interest rates in the next 10 years. Okay, so it's possible when you buy a bond and not just get coupon payments, you might also get a capital gain. And that has to be included when you calculate your rate of return. And that in turn is determined by that yield to maturity. Okay, so now the formula is right here, and you can see all we're doing is calculating the present value of the bonds future cash flows. Now, again, if you notice, underlying all of this is the assumption that those cash flows will actually materialize. In other words, if the company goes bankrupt that issued this bond, well, then obviously that will affect the results. But if failing that, this is what the bond's price will be. And in fact, that's what it will be worth. Now, the yield to maturity itself is unique to each individual bond. I'll sneak that in here. And it depends on, it can depend on several factors. The most important ones are the maturity of the bond. In other words, it matters a great deal if it's a 5-year bond or a 30-year bond. The level of interest rates, the economy, and the credit worthiness of the bond issuer. Okay, and that's just common sense. In other words, it's like an individual. What determines how much you pay on your credit card? Your credit rating. It's just that simple. Your credit score. It's the same thing here. So, and by the way, this also applies to treasuries. The only thing that's missing is that they're assumed to be completely creditworthy. In other words, there's no credit risk assumed with treasuries. Other than that, everything is the same for both corporate bonds and treasuries. Okay. So now, like I was saying, if you own a bunch of bonds, you're going to always have your eye on the market. You're going to be looking to see what's going on at least in the fixed income markets. You'll be focused heavily on what is the Fed saying they're going to do, what's going on, like does the economy appear to be slowing down or heating up? All of these things will have some kind of an influence on the price of your bonds. In fact, if you want to know, by the way, if you want to keep up with this, one of the best sources is cnbc.com, where it'll tell you now, oh, looks like the Dow had a bit of a fallback. The S&P is okay. And then they'll tell you all the details. If anything's going on with the Fed, they'll mention it down here. There's a lot of articles. The price quotes, and then they're up here, you have all kinds of information. It's really, and it's for free. I mean, it's really a great website. But anyway, so now we're going to look at some examples. And so this is a slightly different way of expressing this formula. This formula, obviously, there's going to be one term for each period in which a coupon is received. Here, this is just this is the summation sign, which means we're going through all the coupons, calculating their present values, and then we are calculating this future value. This here is the present value of an annuity then, because all those coupons are exactly the same. Present value of an annuity. And here's the present value of a sum, which the sum happens to be the face value. So this way, no matter how many periods are in the lifetime of this bond, you really only need to do two calculations. Now, also, if you notice here, since R is in the denominator, as R rises, P has to fall because R is in the denominator. It's just algebraically that simple. As R falls, P has to go up because you're reducing the size of the denominator in all those terms. So right here in a nutshell, this is why this is happening. And by the way, you can also draw this. If I took the same bond and repriced it with different levels of R, I would end up with a relationship that looks something like this. The important detail here is that, and this is sometimes called the price yield curve. And that's going to be different for every bond, but they'll all have the same basic shape. And by the way, we'll be discussing this in a lot more detail in chapter 2. You'll notice the curve is not only negatively sloped, but it's not a straight line, it's curved. In fact, it's formally defined as being convex to the origin. That proves to be extremely important, and it actually is helpful to investors. It basically means that when rates go up, you'll lose money in your bond. When rates go down, your gains will be greater than the losses you would suffer from the same increase in rates. So in other words, there's a kind of a bias in favor of the investor here. But don't worry, we'll discuss this in much more detail in chapter 2. For now, what we're trying to do is understand how bonds are priced. Okay. So let's do an example at long last. Here's a treasury bond. Actually, technically, it's a treasury note. And let's see how this works. So in this bond, the face value is $1,000. Now, the face value, by the way, works as is the principal. It's also known as the principal, but we can also think of it as the present. Actually, no, sorry. The face value and the principal mean the same thing. So I'll tell you what I'm going to do here. Okay, just to make it crystal clear that they mean the same thing. Now, it's the coupon, which, by the way, is being paid on an annual basis. We'll see later on that in the United States, at least, most of the time, coupons are paid on a semi-annual basis, and that will affect our results. But for now, we'll stick with a simple case. So we have a 4-year maturity is 4 years. And we're being told that the rate of interest, or in this case, we call it the yield to maturity, is 5%. So we want to know the bond's price. Okay, now there's a few different ways we can go about this. We can do it algebraically by laying out a chart. Okay, in other words, because the coupon is $70 a year, you get $70 every year, and then in the 4th year, you also get your principal back. So what you can do then is calculate the present value of each of these individually. For example, this first one, you divide by 1 plus the rate of interest. And by the way, don't forget that little trick about the dollar signs. This will never change. It's a constant. So we want to surround that with dollar signs. But the exponent is the year in which the cash flow is received. And by the way, while we're at it, let me go get a copy of this and see what we're doing. So you can see the exponent for the first cash flow is 1. And by the way, because of the way I've set it up, I don't have to keep retyping it because B8 refers to the cash flow in column B, and then A8 is the year, which is the exponent. Okay. And then I can just add them up. The price is the sum of these present values so that means right now the bond should be selling in the market for 170.92. Okay. Now, by the way, if the bond has any special features built into it, which can happen, that will affect the price, of course. Like if there's features built into it that are advantageous to the investor, then the price will go up a little bit. It depends on what it is. Like, for example, there could be a clause. I remember we mentioned the other day that when you buy a bond, you're actually entering into a contract, and the contract is called an indenture. And sometimes what the corporation will do, the issuer will do, is to make the bond more attractive, they'll put little extra features in there to help the investor. For example, if sometimes they'll have a clause in the contract that says, we guarantee to hold on us to a certain amount of real property to act as collateral for these payments. That would make the bond more creditworthy, and that would tend to raise the price. Okay, so that kind of thing could affect the price, but basically the cash flows themselves are worth 1070.92 based on this information. Now, another thing you could do is you could take advantage of Excel's functionality. What you can do is calculate the present value of this annuity of $70 a year plus the present value of this $1,000. So why don't we try that now? The present value of the coupons, let's say, will go here. And the present value of the face value will go here. Now, the Excel function that we're going to use, we start with the equal sign. We can now use the special little insert function button. And we're going to look for something that looks right. Present value. All right. Well, it didn't do such a good job. There it is. So we want to get used to this function argument box is going to help us understand what we need. So rate, for example, is our yield. Number of periods is 4. The payment is the coupon. Future value is the face value. So okay. Oh, I know what I did. You know what? I just realized the way I set that up, both of them were included. The one thing that you have to watch out for here, though, is that it's got a negative value here because Excel interprets cash inflows as positive and cash outflows as negative. So it's negative now because I gave it all positive inputs. If I want to change that, all I have to do is put a negative sign in front of the answer. So I just realized, no, we don't have to break these up separately. It included both of them. Okay, in other words, here we did this directly by calculating all the present values ourselves, but in this case, we can use Excel's version. And by the way, I do want to mention when we get to that point in VBA, VBA can access all of Excel's functions. So if you were to write a program in VBA to price a bond, you could just borrow Excel's PV function. And that's exactly what we're going to do. So we want to get used to Excel's capabilities whenever possible, but we also want to understand how it works. That's why it's a good idea to do it both ways. Okay, actually, let me, usually we try to round these to dollars and cents. Here we go. All right, so now here's the interesting part. What I'd like to do is develop a chart in which we calculate the price that it would have for different values of the yield. Now, by the way, here's a fun side note. If I change this, it'll update it automatically. But I'd like to have this all together in a chart. So I'm going to try yields from, let's say, oh, I don't know, let's go up to 10 or 12. And for each one, I'll have equals PV. Okay, rate, which is this number right here. The number of pairs will never change, so this will be B3 with dollars. By the way, on the PC at least, if you hit F4, it'll fill them in for you, F4. The payment is the coupon here, 70. Let's make sure that gets an F4. And then the future value is the $1,000. Again, with an F4. One more thing, in order to make sure it comes out positive, we'll put a negative in the front. And so those are the prices with the different yields. And if you notice, as we expected, the yield goes up, the price goes down. And in fact, when the yield is zero, the price is just the sum of these cash flows because they're not being discounted. So now, if you want to graph this, just to see what this relationship looks like, what the price yield curve looks like. Okay, now a couple ways we can clean this up. I don't know how familiar you are with Excel, but one thing you can do is tell it that you want the horizontal axis to reflect these yields, not these numbers. To go to select data, edit the horizontal category axis label range. Okay, now that was easy, but I don't want all this blank space here because it'll affect the way the curve looks. So I can say, listen, don't show any values on the vertical axis less than $800. So the minimum over here is 800. I think it just looks better that way. Okay, so all right, so let me remind you how all of that was done. I changed the label by simply clicking it on, and I can just type what I want there. As far as the axis goes, in order to change the labels, right click, select data, horizontal category axis labels, edit, and you tell it where the numbers are that you want to act as the axis labels. Okay. As far as changing the values on the vertical or the horizontal axis, you right click that axis and put format axis. And one of the many things you can change is the minimum and maximum. Okay, so I'll leave the maximum, that's fine. Although I guess I could knock it down to 1300. And then you type and then you hit enter and you're all set. Now, if you notice, it's not that curved. You can just barely see that it's curved, but it is, okay? The way I drew it up here was a little bit exaggerated, but still, it is definitely curved. It is convex to the origin. And we'll see later on why that's so important. All right, that's our price yield curve for this bond. Another bond would have a very different price yield curve. Okay, so for this one bond, all these different yields tell me how much the bond will be selling for. Good. Now, here's an interesting detail. Here, the bond's price is exactly equal to $1,000. And if you notice, it's not a coincidence when the yield equals the bond's coupon rate. The bond's price equals the face value. Now, the coupon rate, remember, is the percentage of the face value that we're paying out. So when the coupon is 70, it doesn't show here, but let's do this calculation separately. When we have a face value of 1,000 and a coupon of 70, that implies a coupon rate of 7%. Okay. So the coupon rate is 7, meaning 7% of 1,000. This is where the coupon comes from. The coupon is in dollar amount that you receive. The coupon rate is the percentage. Okay. That remains fixed. That never changes. So I'll just mention that here. The face value, coupon rate, coupon, and maturity are written into the indenture and never change. The yield respond or changes in response to market conditions so that it can change every day. As a result, the price of the bond can also change every day. Okay. So in other words, only the yield can change. These are locked into place in the contract or indenture. So when you buy the bond, you still don't know what the price will be in the future, but here's the good thing. If you hold the bond until the maturity date, you're guaranteed to get your face value back. So the return will be locked in. But if you have to sell it early, then that's when all the risk comes into play. You don't know what you're going to get if you have to sell the bond, let's say in 2 years or 3 years. So all bonds are priced the same way, but if there are other features mixed in there, it can get a lot more complicated. This is just a straight ahead, plain vanilla bond. It's like, let me give an example of a bond that has interesting features built into it. Just as an example, what can happen. So I'll just repeat here what we just discussed. The bonds, face value, coupon rate, and coupon. Oh, sorry, coupon and maturity are written into the bonds indenture. The yield to maturity, and therefore the price of the bond, change every day. So for a bond with no special features built into it, price is equal to present value of its future cash flows. Special features can either increase or decrease the value of the bond above and beyond the present value, that is. So let me show you a quick, simple example of this. For example, a bond may be convertible. This means that the owner, the investor, has the right to trade the bond for a fixed number of shares of the issuer's stock. Wow, that's kind of a nice feature. It would be like, imagine if, for example, an Apple bond may be convertible into 5 shares of Apple stock. Okay. Now that's a very powerful thing to be able to do, especially if the stock is doing really well. You may say, you know what, I've had enough of receiving such a small interest payment from the bond. I want to share in those capital gains. So I trade my bond for 5 shares of Apple stock directly from the company, that is. So because this is such a powerful feature, a convertible bond will always be more expensive than a non-convertible bond with the same features, that is. So in other words, in a case like that, you can't just calculate the price of the bond directly as its present value. You have to explicitly consider that ability to convert it into stock. And that's, of course, going to make it a lot more complicated. Now, we will be seeing as we go along how to do this kind of thing. We'll be seeing how to first price the bond in VBA and then how to take into account special features. But for now, we're just focusing our attention on, like I said before, what we will call plain vanilla bonds, the ones that are just cash flows and that's it. No other special features. All right. Now, here's an interesting thing to discuss. The yield to maturity. We want to take a closer look at the yield to maturity. Up to this point, we've been taking it as given and then using that to calculate the bond's price. But it turns out we can actually work this backwards. Okay, in other words, if I know the bond's price, coupons, the maturity, and all the rest, I can figure out the implied yield to maturity. So this is one of the interesting things about this. The bonds face value, coupon rate, coupon, and maturity are directly observable in the market. The bond's yield to maturity is applied by these values in the bond's market price. Implied. So in other words, you don't directly observe it. It's something you had to figure out from the pattern of cash flows. Interesting. Okay. And it's not easy. It's a very complex process because what you're basically doing when you calculate a bond's yield to maturity is you're taking this equation where was I? Based on the pricing equation. Finding the yield to maturity means solving for R. So you might say, well, all right, well, let's do it. Let's algebraically rearrange this equation and find it. But it turns out that that's not only horribly complicated, but when we get past a certain number of terms, it turns out that it's impossible. In fact, there's a result due to Descartes. I forgot exactly what it's called. We can look it up, where he proved that if you have an expression like this with more than, I think it was 5 terms, then it becomes mathematically impossible to solve for R. So we're not going to do that. We're going to use a special technique called numerical methods. We're going to solve with what's going to be called a root finding technique. We're going to solve for R. Now, that is the kind of thing that requires a computer. You do not want to do this in a calculator because it would take forever. So this is when we suddenly start needing more powerful tools like VBA, because what it basically is doing is it's searching through all the different possible values of R until it finds the one that makes this equation work. So now that is, as you can see, jumping ahead, here we have our first look at what is called root finding techniques. And these are the ways that we can solve for an equation like this that technically or would be very difficult to solve implicitly, or sorry, explicitly. What we're basically doing is solving it implicitly. So sadly enough, I think we're going to have to cut it off here because this is a very complex discussion. So we'll save the rest of this until next time. But even then, I think we may postpone it just a bit until we start looking at VBA. I just want you to get the sense of what this is all about. Then what I'd like to do is go through chapter 2, which discusses bond risk, or in other words, the risk that our bond loses value when interest rates fluctuate. Okay, but for here, I think we can stop. We've got plenty done for the first week, and then we'll pick it up from here next time. Okay, and by the way, there's no assignments just yet. We'll just continue to learn new material, and then at some point we'll start to introduce VBA assignments. All right, so see you all next time.